This is John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, May 24. To view our full range of products, visit our website at investingdaily.com. Today, I will explain why you should make sure your portfolio is internationally diversified. Some of the best investment opportunities right now are overseas. Q1 corporate operating results indicate as much. I'll get to the Q1 numbers in a minute. We've witnessed an uptick in volatility as mixed economic reports, combined with fears over inflation and rising interest rates, have whipsawed investor emotions. However, the economy overall is accelerating and corporate profits are surging, placing a sound foundation beneath the stock market rally. My view remains that interest rates are getting higher, sure, but historically they're still not high per se. During the previous 5 stock market peaks, the benchmark 10-year U.S. Treasury note averaged 6.8%. It currently hovers at only 1.6%. Take a look at my first chart. Inflation numbers have been running hot, but the overall trend for employment has been positive. The mixed economic scenario put stocks on a roller coaster last week, with sharp sell-offs followed by powerful rebounds. When the dust settled by the closing bell last Friday, the major indices, well, they hadn't moved all that much for the week. Take a look at my second chart. Look, I remain optimistic about the stock market this year, and I expect further gains ahead. But you should fasten your seatbelts and stay properly diversified. For example, if you hold Bitcoin right now, you've been reaching for the antacid lately. Contradictory comments by celebrity billionaire Elon Musk, as well as disparaging remarks from public officials, have sent Bitcoin tumbling. Take a look at my third chart. Amid these myriad risks, how can you partake of growth but still protect your portfolio? International diversification is key, as recent data from Q1 earnings season attests. As of May 21, 95% of the companies in the S&P 500 have reported earnings for the first quarter. For Q1, the blended year-over-year earnings growth rate for the S&P 500 is 51.9%. That's pretty darn good. The blended revenue growth rate for Q1 is 10.7%. For companies that generate more than 50% of revenue inside the U.S., the revenue growth rate is 8.9%. For those that generate more than 50% of revenues outside the U.S., the growth rate is 16.2%. My fourth chart tells the story. At the regional level, companies with more revenue exposure to the Asia-Pacific region outperform companies with more revenue exposure to Europe. Companies with more than 50% international exposure that also had more than 25% revenue exposure to Asia-Pacific had revenue growth of 21.6%. Companies with more than 50% international revenue exposure that also had more than 25% revenue exposure to Europe had revenue growth of 11.8%. My fifth chart explains it in better detail. As the global economy gains traction, the Asia-Pacific region is home to inherently strong growth stocks that are value plays. Positive factors for the region include population growth, higher education levels, greater technological savvy, and the expansion of a free-spending consumer class that skews toward a younger demographic. Countries in the East also were quick to get a handle on the coronavirus pandemic. China has resumed its role as global growth engine. The country's Q4 2020 growth rate exceeded consensus expectations, pushing growth to 2.3% for the full year. This comeback made China one of the few major economies in the world to record positive growth during a year battered by the pandemic. Economists expect China's GDP to expand at the torrid pace of 8.2% in 2021. The upshot? If you want to tap market-beating growth that isn't overly reliant on U.S. economic indicators, go global. Well, that's it for today. If you want to reach me, send an email to mailbag@investingdaily.com. I try to answer all inquiries. Thanks for watching. Stay safe and stay invested.